Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Jerome Powell's future and what we're seeing in the housing data despite some crazy headlines. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. You're getting your voice back. That means you're going to boss me a little bit more. I'm ready for
always.
it. I had my spring break without you.
No, I think you missed me. I think you were like, no, she has to come back and boss me some more.
I know. It's weird not being bossed around.
You get used to it. Okay, well, we have some pretty explosive things to talk about today. Jerome Powell, man, he got a target on his back more than ever right now. So, Trump had his comments yesterday. You wrote an article about it. We're recording this on Thursday. How much trouble is Powell in?
I'm actually going to take even a different angle on this. I think there's going to be in a sense, a very interesting civil war among the Fed presidents and Powell.
Okay.
And this week, oddly enough, we always say Team Logan has two new people. Fed Chairman Waller, or President Waller, and Michelle Bowman. Both those two hawks have now gone into labor over inflation. But Christopher Waller basically gave his premise on how he would handle tariffs. And he basically said, listen, I want to get rate cuts going if the labor market is breaking or the economy is really getting weaker. Powell, on the other hand, kind of said, hey, listen, we're going to sit and watch. It was kind of like, listen, this is your thing. The tariffs are much bigger than we thought. It makes it more problematic for us to do our mandate. I'm always in the camp that when labor breaks, they fold. But hypothetically, let's say Powell is not budging. Jobless claims are rising. The unemployment rate's coming up. You have Fed presidents like Waller and Bowman saying we need to start cutting rates, and Powell doesn't. Trump is going to really, really try to rally the American people against Powell at that point. Because it's one thing for Trump to, go after him while the economy is still expanding. And, he's just going to ignore it. But assume this hypothetical that jobless claims which jobless claims came in fine again today, right? The honey badger labor market is still holding up. But let's say jobless claims are running at 323,000 4-week moving average. And then Powell just goes, listen, we're just going to sit and wait. And there's where I think Trump could, start to push a full-on blitz against him and also elevate Waller and Bowman, who are both conservatives, to try to get more aggressive rate cuts going in. I believe Powell will fold when the labor market breaks. And we've always said this, well, I think it was in 2022 too, that they're going to stay as restrictive as possible until the labor market breaks. And Powell's and a lot of Fed presidents says we are modestly restrictive. So we haven't even talked about like going to an accommodative stance or anything. We're just trying to get to neutral. So just before we got on this podcast, Politico broke out a story saying that Trump was furious, just absolutely furious at Powell. But Besant is trying to calm him down, saying it'll be unstable to the markets if you try to fire him. It'll go to the courts. It'll be this whole thing. Does Trump really care what Besant says? Not probably really, but I think there's going to be an inflection point. And again, the labor data runs everything here. So that's where you could start to get Fed presidents almost getting in a civil war where they openly go against Jerome Powell and say that our dual mandate is maximum employment and stable prices. Tariffs are a one-off price. They'll get some deals done. Things will go back. Let's get ahead of this. And there's where you and I talked about this like 4 or 5 weeks ago. The Fed can be in a place where they make an unforced error, and so is President Trump trying, if they do something that is a little bit more extreme. Godzilla tariffs is really extreme, but now Powell's taking a stance about, hey, listen, we're just going to wait. New York Fed President Williams says, hey, listen, I've got the unemployment rates going higher, growth slowing down, but we're okay where we are right now. So they can say all this as long as jobless claims are low. But when that dam breaks, boy, it's like we've always said, Sarah, it just gets more interesting. But that's the variable that's keeping them saying this, these data or these talking points.
So from your perspective, the cover that the Fed needs, so say Jerome Powell really wants to not make Trump furious or sees it, the only cover he really has is on the labor data, right? I mean, he couldn't just now say, oh, okay, I'm going to do that. Like there's no real reasoning behind that.
The irony, Sarah, is that the inflation data, there's no 1970s redo here. I mean, CPI inflation, PCE, it's so hard to get inflation to break out like that did. A global pandemic did it. And I encourage everyone, go look at the year-over-year growth inflation data in the 21st century. We had deficit spending, QE1, QE2, QE3, Operation Twists, zero interest rate policy. We threw everything out. Could I get the growth rate of inflation to break out? But pandemics are very inflationary. Global world war tariffs, they all say tariffs are a one-time price, but the trade war, Powell said this, listen, we might have shortages because this part is made here and that part, and things don't work together and it takes for a long time. And look how long car inflation has been. Used car prices are still elevated. He used that as an example. So while the Fed will say tariffs are one-time price-offs, they're already starting to make a claim that, hey, listen, we can't be 100% sure, because if this is a bigger trade war, then things aren't going to be working properly. And that's always been a problem with trade wars. It's not like you get to just declare whatever you want and nobody retaliates on you. Everyone retaliates, and unless you make deals, it gets more problematic. I mean, the manufacturing survey data is just collapsing. I mean, it is interesting. Some of these data lines actually look like COVID. Travel from overseas has had a waterfall dive. The new orders has a waterfall dive. The trucking data has had a waterfall dive. These are surveys. Some of these are harder data than softer ones, but the Fed and Trump's economic team is saying the softer data is getting weaker, but the harder data hasn't. Which implies that the data in 2024 was fine, because if the data is fine now, it was fine then. But in this case, you get to really see why everyone is just waiting to see some of the other data lines. For example, retail sales beat estimates. Some people would say that's front loading on tariffs because cars and building materials were the big growth here. Jobless claims still there. The labor day, we talked about this with the bond market. The bond market 10-year yield should be trading at. By the way, what a wonderful week on the 10-year yield and the bond market, behaving absolutely great. And even with Powell's comments and stocks selling off, it wasn't like the 10-year yield had a waterfall dive. It fell a few basis points and now up a little bit. So bond markets have calmed down. So the hard data is the key for both Trump's team and Powell's team. But I do think within the Federal Reserve, you're starting to get a divide on people saying we care about labor over inflation. We don't think this is going to be a long-term breakout in inflation data, and Powell's already taken the side. So when you take sides, you got to go with it and stick it. That's why the next few months, if deals aren't made and things don't get better,
on the
we'll
tariff
see
side,
who really shows up for the war.
Whew. So just very briefly, how bad would it be if he tried to replace Powell? Obviously, up till now, people feel like, that's an independent post. You can't really do that. Aside from the legal part of that, what kind of instability do you think that would lead to?
Well, see, this is where I actually am interested to see what the markets do. Now, you can't just literally fire him and just tell him to leave. It's a whole process. Unless Trump's legal team has found some crazy verbiage or something that they can do something like that, it's not an easy process. But this is my working theory. If the labor market is breaking, I don't think Trump cares. I don't think he cares about what the markets think. If jobless claims are going up, people say, well, it's instability, like Pesset's telling Trump, you can't. I don't think he gives a damn. I think at that point, he's just fired, and whatever it is, he's going to put the pressure on him at that point. Obviously, let's say a bunch of deals are done and things go back to normal. It wouldn't be a big deal. But in this context, we've already got people on the other side. So always keep an eye on Bowman and Waller now on any Fed speeches. We'll highlight that when we can, but those two have now separated themselves from other Fed presidents, and we'll see how that works along in the future. But I think everything changes when jobless claims break, when residential construction workers lose their jobs, and we enter a different stage of this cycle.
Let's talk about against that backdrop, the housing data, because the housing data in many ways is holding up. So what do you see there?
Before we talk about housing starts, I just want to add that a lot of people are saying that people are kind of afraid for their jobs. Confidence has never been this terrible. And even with rates getting above 7%, the purchase application data had 13% year-over-year growth.
What do you attribute that to?
Sarah, you and I have talked about this.
Yep.
And I know Ivy Zellman talked about this. I know Mike Simonson has talked about this. If people are really afraid, just panicking all the time. It's like those bond traders a few days ago. Everyone's going to buy the dollar or whatever. God, marshmallows. Such marshmallows, Sarah. If they really were afraid, they wouldn't be applying for a mortgage, right? Fear trumps the purchase application data. Pun intended, by the way. However, for this year, even with elevated rates, it's one thing if it was like mortgage rates were at 5.5%, and then you go, okay, you get it, right? Rates are elevated, and it's still showing growth. And people go, well, the total volume. No, this is year to date is positive, year over year growth. We just had one rate spike. We saw the week to week data get softer, but we're still showing positive. We haven't had this in many years. So going out in the future, if this continues and people talk about fear, but yet they're applying for mortgages, something's wrong. Something's wrong with the premise. Because if you have fear, you contract yourself. It's like nobody wants to travel to America. So guess what? All the travel data has had a waterfall dive. That makes sense. But you can't say that people are starting to be afraid and then have purchase application data still be positive. And this is with elevated rates. Again, if mortgage rates were sub 6%, people just go, hey, listen, rates are just lower. We're going for it. But the fact that this is happening should make some people be a little bit mindful of the fear part in relationship to the data, because our weekly contract data is still positive year over year. Our total contract data is positive year over year. The purchase application data is positive year over year and year to date. There is something a little bit different this year than other years. So it's hard for me to kind of buy into the fear factor yet.
What do you attribute that to, though? When you look at that, what do you think that variable is?
I was 7 when this happened, but the early 1980s, and we've always highlighted this as part of our work for the last year. This housing market reminds me of the early 1980s. Now, of course, back then I was watching Spider-Man, the cartoon Spider-Man. Back then was that
I love how you bring up your age. I know what you're doing there, by the way.
I'm just talking about how young I was in the 1980s. In any case, the late 1970s, home sales went from 2 million to 4 million. Big push, right? Huge. The baby boomers back then were buying homes. Then from 4 million to 2 million, 18% mortgage rates crash. And then home sales flatten out. What does it remind you of? We had a huge crash in sales in 2022, and we flatten out. Every year, wages rise. Every year, households form. Every year, people get married. Every year, people have kids. We have grown a lot of jobs since 2022. So at some point, and we always talk about that 4 million level as being the key, that 4 million level held both in 2023 and 2024, existing home sales. We're not counting the new home sales here. But back then in the early 1980s, we had 2 recessions. We had a lot more inventory. We had worse credit data, and affordability was worse. But yet, when mortgage rates went lower, there was a movie, Sarah, a while back. It says, life finds a way. right? And there are certain things that people consume each year, and housing is one of them. So we always said, when rates fall, like I have no equivocation whatsoever. If mortgage rates are below 6%, sales are growing, no doubt about it. I would gather every single person in America, raise your hand if you tell me home sales are going to fall with sub 6% mortgage rates. No, I don't think a lot of people, some people are crazy enough to say that. But in any case, it's just when you work from the lowest levels ever, it doesn't take much to move the needle. And we're getting to the point that even elevated rates are just smidging the data a little bit higher. But if we had just gone down to 6%, right? This is why the housing starts data is so frustrating to me. If we just go down to 6% and stay there, you can grow sales a little bit more comfortably, right? You know, we say 70 to 80% of home sellers are buyers, but they need that mortgage buyer to get that initial sales in there. And then that person can sell their house and buy another house, and a functionality, another mortgage buyer comes in, and then you start growing. But man, if this data line stayed positive year over year with a rate spike, with all that's happened, this is April, homies, this is April. We're not talking about December or January. We're talking about all hell just broke loose, and yet people aren't running away. And what do we say? American home buyers are not middle-aged men, podcast stock traders and bond traders. Oh, they would run. Woo, Nelly. They're running to selling, get out, start crying about, oh my God. Homeowners, educated, proud, strong American homeowners, home buyers. They live in they just have their normal life. This is just a normal process that happens every single year. So if people are like confused, I get it, because everyone's telling you, everyone's afraid. Everyone's so afraid of this happening, that happening, and yet the data is positive. If purchase application data was negative year over year, 13%, and mortgage rates were down to 6%, and we had that happen, then I think people can make a claim that, well, even though rates are lower, confidence isn't there. But the exact opposite has happened in the most extreme, violent, headline, crazy time in recent history with elevated rates. So I just want you all to think about that for a second. So the next time somebody tells you people are afraid, I believe there are some people that are afraid. But as of now, just the home buyer thing doesn't have much validity in that. And if mortgage rates had gone towards 6%, home sales are growing more than anybody else thinks. We're just not there yet. But even for me, I would not have taken that bet if somebody told me mortgage rates would have been elevated 6.64 to 7.25, and you would have had positive year to date and double-digit positive year-over-year growth after when rates spiked. What? I wouldn't have taken that bet, but it's here. So again, our personal beliefs on what should or shouldn't happen, that's fine for anyone to have. But if the data doesn't support it, then that means your hypothesis needs to be, looked at in a different way. So we'll see. I mean, rates have come back a little bit. We'll see how it goes. I'm surprised at the data, but clearly what the first few months have showed, if rates get down to 6%, we're growing sales more than anybody else thinks, just because the bar is so low. These are record low levels of sales. So it doesn't take much to move the needle. That's why we've constantly pounded that line, because at one point, there'll be an inflection point, and you don't want to be like these people that we have literally people sitting there for like 2 years talking about one home in Florida that was bought in 2022. Like, get a life. Literally get a life. We have this whole economy out there, and then there's like, oh, look at this house. And there's this one group of people, Sarah, just one group. You see these clowns in the YouTube comment section. By the way, to the YouTube comment section, man, come find me on X. Oh, homie, please come find me. Just stop hiding behind your fake names. Come, we'll do our forecasts and models, and I'll add you to the list, because I have this whole list of people's names and faces and their calls for the last 13 years. And oh, Lord, the people that are still talking, it's hilarious that they're doing. And again, I understand for some of these people, this is how they make their living. Because of that, I am showing mercy. But some of you people don't do this for a living. You're just born just doom porn every day. You got kicked into a cult. You're older now. Sarah, doesn't get prettier for guys when they get older. They ain't no Dorian Gray. They don't got Logan's hair. But man, it just gets tough. You get angrier and you get frustrated and you can't do the things when you were younger. and you just get mad and you go online and you go, ah, the world sucks. No, you're just aging, dude.
I really appreciate, and I know our audience appreciates your focus on data. So I saw a story a couple days ago, and it was like buyers in droves are pulling their contracts because of what's going on in the economy, and they're afraid, just exactly like what you were talking about. It's like, if you sat back, I could see how someone could think that. I could think that, like, oh, all these headlines, all this stuff, but the data just does not show that. And I immediately called you. I was like, hey, what is this person looking at? But when we looked into it, it's like they went and talked to a couple of people. There were no quote unquote droves of buyers. They had no data about people in large numbers pulling contracts or anything like that. We're watching that really closely because, of course, our audience would be very interested if that was happening. But the data is telling a different story, and it's confounding in some ways, but it is the data.
There's always withdrawals of contracts that we have seen in whenever rates spike in a very short amount of time. You see people withdrawing their contracts because they never locked and they don't, want this. There's withdrawals every single month. It's like the jobs data, which again, this is something that I probably failed as a teacher. People get fired every month. Like we have 1.5 to 2 million people fired each month. Like people see these reports that, oh my God, this company why aren't they? Then 1.5 to 2 million people literally get laid off every single month. Every single month we do have a withdrawal or cancellation. I would tell you this, the cancellation data that actually was really picking up steam was in 2022. And that was for the builders. Like the builders were getting cancellation rates like crazy because remember, those people have to wait for the houses built. Then that final month they go into the purchase. And then, when rates go from like, oh, I was going to buy this house at 3.5% and now it's 7%. Of course, you're going to get high cancellation rates. Mike Simonson is going to have some data on this, and he's going to start showing withdrawals rates and percentages. It does occur. What you want to see is tied to an event if there's any uptick. Like I totally get it if some people just like people that work for the federal government. If you see your coworkers getting laid off, do you really want to make that purchase? I mean, you technically, if you're in the loan and then you got laid off the last day, they got to check that anyway. And they're really going to check on anybody working for the federal government now more than ever. So yeah, you withdraw that. So it's something to see going out in the future. But so far, it's purchase apps are positive. Weekly, it isn't anything spectacular. But again, for me this year, this is happening with elevated rates, not lower rates. When you have lower rates, you can really make a lot of different cases on what is happening or not happening. But the fact that we're just here now just shows that we're working from such low levels, it doesn't take much to move the needle. But the headlines, I mean, listen, the consumer confidence data is so bad. Like we literally have like inflation expectations spiking out of control and employment, losses. People are worried about their jobs. But for now, the data line that we track for housing has held up very well, considering everything, elevated rates, trade war headlines, stocks pulling back. You have all the intangibles there. And in theory, if you believe in your concept, then people should not be applying for mortgages. We should see another big downdraft, down 10% every single, but it isn't the case. And I think home buyers are just in a more emotionally stable spot than middle-aged men podcast stock traders who complain about this all the time.
Okay, last topic is the builder's confidence and the new home construction. Let's talk about that.
Yeah, it's a frustrating thing. We wrote that article yesterday. Housing permits, walking dead, literally just a walking dead. New home sales. I try to explain this because a lot of my Wall Street friends, they don't understand why aren't the builders laying off people? Well, if you look at new home sales, it hasn't gone anywhere. Like when rates get down to 6%, new home sales grow. When it goes back to 7%, so it's basically hovering in a range. So housing permits have been hovering in a range for a few years now. It's literally not going anywhere. we're not building. Remember the construction boom everybody said? And what do we say, Sarah? Oh, you're so cute. You're so adorable. You're such a good baby. When rates go up, it's going to end. So here we are. It's 2025. Housing starts, permits are still at basically the early levels of COVID-19. We're still building homes. Like, it's not like we're down to zero. It's just the growth that people had anticipated. The builders' confidence had an uptick on 3 of the 4 data lines. But the big one, the forward-looking 6-month one that I usually track with economic cycles, that went down again. So hypothetically, let's just say there is no tariffs on lumber or anything that impacts the builders. And again, 7% of what the cost that goes into a new home is imported. If mortgage rates were at 6% and there's no tariffs, I'm pretty sure all the builders' confidence index would be rising together. And we could probably start getting permits to grow again. We're not there. And that's just, it's 2025, it's April. And if you look at the housing starts and permits data, single family, it's just not there. But because new home sales haven't broken below the 2022 lows, you haven't seen that next level of contraction in the permits or start data. Multifamily permits are very wild month to month. It had an uptick, but if you look at it, it's basically at COVID-19 recession levels. There's not much going on there. So when you're talking about growth, man, permits are rising, single family permits, total housing permits, new home sales, all these things are moving together with housing starts. And that's what's happened with other economic cycles. This is a very, very unique cycle that housing permits have been basically going nowhere, but the economy is expanding. Some of that is we still have the backlog of homes. We're still getting things done, but it's a very unique cycle. I've made some even more adjustments to my model because of it, but the whole notion that we're going to have this big, massive construction boom is just no.
Sadly, no. I mean, we would love to see more houses.
Yeah.
Just not going to happen. Logan, thank you as always for bringing in the data and giving us the context that we need. Appreciate you so much.
Pleasure. It's good to have you back and get your voice back. And we're rounding up the Nerd Tour again. We got a bunch of cities coming up, and we're booking things for the second half of the year. And it is going to be the largest Nerd Tour we've ever had, especially the second half. So a lot of states. It's going to be a lot of fun. Hope to see a lot of you guys. And the Nerd Tour charts just get more interesting with all the new data.
Well, and I will say, let's point out the fact that we are coming up on the Gathering, which is HousingWire's big event and bigger than ever this year. We've already sold out of some things. Incredible people on stage, including you, Logan, being our keynote. So people need to come to the Gathering at the beautiful Broadmoor in June just to hear you.
Pleasure. It's going to be a lot of fun, Sarah.
It's going to be fun. Thanks.